There we go. Okay. Welcome, Brian and Sam, and then to everybody else who will be watching, either joining us later or watching later on, either through the Mortgage Jobs YouTube channel or distribution through our various social media channels on Twitter and LinkedIn and stuff like that. We like to chop these up and create little reels too, so that's always fun and tend to get a lot of viewership through that. So excited for another part of our ongoing series of different speakers and investors across the country. This will be an interesting one because Brett and his team have some pretty cool models and things that they're involved in that directly relate to stuff that we're all doing. So Brett, why don't you just start quick intro on yourself and scale kind of things you're involved in, then tell us your story. Start with that.
Yeah, thanks, James. Thanks for having me and allowing me to do this, meet some folks. So I'm Brett Calhoun. I run Scale, which is a early stage fund based in the Midwest. We invest out of two models. One is a venture studio. How we think about the venture studio is we have internal ideas, we suss those out, do some market research, customer dev, and then bring in a technical founder to build that company. On the Accelerator side, it's sourcing investments across the US, and being in the Midwest, we have a focus on that, and it kind of fits in with our thesis, which is that the driver of venture returns are founders strengthened by struggle. And in undercapitalized areas like the Midwest, founders are pre-exposed to more levels of struggle, more constraints with capital network effects. And so the ones that push through that can generate outlier returns. And so although we're not just investing in the Midwest, it is somewhat of a focus for us. We're generalists, so we invest in any industry. And part of the reason being, one is historically generalist funds have produced higher alpha than more thematic funds. And two, we're focused on founders. So we go at the earliest stages, we're vetting people not based on their pedigree, but based on their personal characteristics. And what we believe points to this person could be a successful founder, and they could push through some of the struggle and turmoil they're going to face in their venture building journey. And in addition to the Accelerator, so kind of how we think about venture building and run this is, it's not so much about the stamp of approval of getting an Accelerator logo on your company's website. It's more about, hey, we have a bunch of very successful operators on the level of building multi-billion-dollar companies, and we surround founders with these people to not remove constraints, but to help remove some of the unnecessary barriers and be more of like a compass that can guide you through some uncharted territory. And so we really lean in on the one-on-one time and actually being more of like the person that you can trust, like an investor, as opposed to just saying all the good things that happen with your company. It's like, hey, I have this founder who's built a multi-billion-dollar company that I can tell all the bad things to. They can give me feedback, insights, or just be there to listen. And so we try to take more of an intimate approach at helping founders. And Willie, Jay, and me started this 18 months ago, and we've done investments in 22 companies now, and they're all still alive, active, doing great. Some have raised big rounds, some have done phenomenal with revenue growth, being profitable in these crazy markets. And we continue to do this for the next 10, 15, 20 years.
Wow. So I want to ask about your background specifically also, but before I ask that, just to clarify, Scale is only 18 months old?
Yes. So we started this 18 months ago. Coming in the Midwest, being in Columbia, Missouri, first off, nobody's heard about Columbia, Missouri. So we had our own constraints. I mean, we started with a smaller fund, more friends and family as LPs. We're doing smaller check sizes. So for us, we had a constraint that our capital investment wasn't competitive compared to other investors. And so it's, getting conversations going with founders and pitching them on the idea that the intangible value that we can offer can really move the needle and change the trajectory of their business. And And so, the first two cohorts, it took a bit of time to get that brand recognition and trust on a more national scale. And I think we're starting to hit an inflection point where our applications doubled this last cohort. They're good applicants too. So 90% of the companies had a technical founder. The founder was technical, or they had a technical team member. So solid teams. But yeah, we've only been around for 18 months. So it's been a grind.
Wow. And you got through 22 investments in that time? Is that what I just heard?
Yep. So first investments, we started June 15th of 2021, kind of laid the groundwork for getting the programming ready, some of the sourcing, started the cohort in September with 7 companies, and then did a second cohort in April of 22 and just started our third one in September of 20.
Wow.
Can I ask,
Yeah.
I'm more in the high tech field. And so what is you said you're a generalist, therefore that could mean anything from, real estate to shoemakers. I don't know. But the question is, do you have a favor in where you go because you understand that the market volatility is there and breakthrough technologies could do something? Or you're looking at, I know you said the Midwest, because I look at the central New York as a place where, like the Midwest, it really is in need of investment support. And if you look at, all of the technologies coming in, like Micron and their $100 billion plant, and the activity going on with Nano at Marcy, there's a high tech potential in central New York. And you've got SUNY IT, and you've got Cornell, and all these universities that have humans being developed that really could either stay in the region or jet out to, the 128 belt in Boston or out into the West Coast. But it would be great to be able to have technology investors looking here as a place where a whole new, what I call the nano corridor for the last 5 years. And maybe I was right back in 2018 when I announced it, but who knows? It'd be nice to be able to have supportive technology companies in this region, but I think there's a lack of seed capital and initial investors. And so all of that backdrop to the question of, do you see central New York as a place where you would look to focus some portion of your attention? And if you did, would it be possible that technology companies could have a favored view from you, or do you not have the ability to kind of vet out those types of new company startups, and you're more into something that's a little less, let's say, risky?
No, we are the most risky, I would say. We only do tech companies. So,
okay.
And we go as early as the idea stage. So it's, yeah, I mean, we've invested in somebody who had an idea 2 weeks ago, and then we made an investment.
Yeah.
Got a quarter of our companies are hardware. So we'll get into the risky stuff. We've got 3 robotics companies. And those are early stage, like prototyping, building the product in the garage type robotics companies. And we're able to do that because of some of the people we have on our team and some of the advisors we have. So a little backstory on, it's myself, Willie Schlacks, and Jay Malik as the core team. And then we have advisors who have also built companies. Going into Willie's background, so Willie and his brother started a company called Equipment Share right here in Columbia, Missouri. So they're a top 25 YC company. Started that in 2015, have built what I would imagine now is probably the largest construction tech company in the world. I mean, they're vertically integrated from construction, robotics, equipment leasing, real estate, geofencing technology, telematics. I mean, it's completely vertical. They're even expanding horizontally in some other industries. And they're a multi-billion-dollar company. And so they've gone from 0 to 4,000 employees in 6-7 years. Wow. And so we have the expertise to not just pick companies at this stage and understand who the winners are at a personal level, but also impact the companies from a, this is how you do customer discovery, product discovery. Here's a network of people, industry experts, and we can offer that to people here in Columbia when it's typically not something they're exposed to. We could do the same thing in New York. I have 3 companies in New York City. One is a team of girls. They just graduated from Cornell. So we're happy to invest in Central New York.
Okay, because that would be a good conversation, because a lot of what and the question is, there's hardware companies, right, with their necessary firmware and maybe some software support on top. And then there's software companies, and then there's service companies that could have a blend of software and services, where services is the beginning point and software becomes an evolutionary stable for ARR and good incremental revenue and profit, while at the same time service allows them to become locked in. And I see a lot of things that could evolve, not only in the company that I have, which is Digital Solution Group, but what I see as a lacking of other types of technology companies that, in my mind, should be, the halo effect of these other nano centers. And we've had drone technologies. There's one of the things that we were doing in Herkimer is we have this vision of taking what we call the Quackenbush building and developing a youth STEAM on one floor, adult STEAM on the second floor, and then incubator and business development on the third. And then there's other property within the facility that could be used for leasing space to businesses that want to go from ideation to formation to execution, right? And so, but I don't see in this area a investment team that can look at things and say, I see it, or say, you're really chasing a rainbow, and be able to do so with some level of certainty. So it'd be really good to have a conversation with you offline and talk about some of the things, like, the guy who had an idea 2 weeks ago. Well, there's probably things around here that have not walked out of their home office or their garage because they don't know who to talk to. And I really like to, that's kind of what James does with this thing, but there's not a big audience, as you notice. People go where they think they're going to find value, and depending on who's in the audience, you may say, I'm not going to attend because what are they going to tell me? Something I already know. But you seem to be talking about something, if you have interest in Central New York, or at least vetting out whether Central New York is a good secondary spot for developing ideas. It'd be nice to be able to have a follow-on conversation with you offline and talk about that, because I think we're in want of your type of personality.
I'm happy to talk offline, and eventually, like down the road, we want to do this on an international scale, but right now we want to help nationally. And so, let's definitely talk offline.
I can either connect you to, or if you want, you can share your email in the chat there, Brett. Up to you. So,
well, I'll share 2 things. I'll share my LinkedIn and my email, and that way you have both, in case you want to vet me out and say, well, I think this guy's a crazy person. I'm not going to bother dealing with him, and I'll respect that decision.
We're kind of a community of crazy people, so that's kind of a you sort of have to be to do this stuff. Brett, talk about your background a little bit.
Yep.
Tell me your story.
Yeah. So I started in accounting and finance. I did the CPA route, never did public accounting.
Huh.
What's that?
No, I'm surprised to learn that. I didn't. I was reading your bio. I didn't hear that.
I do have a CPA. I
Wow.
typically don't market that because I don't want people to think that I operate from that side of the brain.
Yeah.
But yes, I do have like somewhat of an analytical skill set. And so I did valuation work for a bit with small businesses to Fortune 100 companies. And that was on whether it was sell side M&A, so transactional, working with PE groups or doing litigation work. I got into the startup industry was when I was in grad school at Mizzou. So I was getting an MBA and had the opportunity to take a class on angel investing. Students ran a fund. We sourced deals, did customer discovery on the investments, diligence memos. Like it was really interesting, intriguing. I had never been exposed to venture, especially being in the Midwest. It's not something that's really talked about much. And it's almost seen as like a secret society in some sense, where because it's not as widely accepted as it is on the coasts. After doing that, I ended up, we didn't have the class anymore, but the guy that had started that fund asked me to come work for them. So for 9 months, I helped him deploy the rest of the capital, fell in love with it. I was like, how the hell is this a job? Have this corporate structure. You're working with people who are extremely passionate about what they're doing. You're seeing all this cool innovation coming out, getting on the ground floor, helping people commercialize cool ideas the right way. So from that point on, I was like, I'm going to do everything I can to try to get into this industry. Ended up working with one of our portfolio companies called Paytient, which is a fintech company in the healthcare space. They're based in Colombia. And when I was there at the time, I think we had about 1,500 employees using the Paytient card. So it's an employee benefit, interest-free line of credit for healthcare expenses. And I want to say they just served their 1 millionth patient now. So they've grown exponentially over the last 3 years. Worked with them, and then I worked with the LegalTech Fund, which is the first venture fund focused on legal technology. And I didn't just want to be on the investing side. When I was there, we also incubated a company called CapGains. So I was the first person on the CapGains team, and we're building software to simplify complex tax incentives, starting with QSBS. So, which kind of goes into, Zach Posman, managing partner, was like, hey, you should work on this project. You have a CPA, whatever. Which was really interesting because when you dig into QSBS, it touches so many different things. And it's not just early stage venture, it's even downstream with private equity groups when you're trying to structure different transactions and save money on taxes, increase IRR for LPs. So I did all the content for the website, customer discovery, made the first sales, and we were still trying to figure out who the customer was. So backstory on QSBS, if you're an investor, founder, or employee in a company, and you sell your stock in 5 years, you don't pay taxes on the first 10 million in gains. So massive tax savings. Anyways, a lot of people miss this because either they do something with the business that kills the QSBS, or they just don't even know about it, or they can't figure out how to qualify or check the box. They can't get the information to do so. So we import all the data on the company, financial data, legal documents, and spits out an automated analysis saying, hey, here's all the red flags or green flags for why this is QSBS. So we've actually gotten to a point now. I run Scale and do other things now, but that was earlier business I was on the founding team of. Around the same time, I also co-founded a company called Charlie Mike, which I tinker with that in the evening time now. And we're a lending startup for veterans. So we partner with mortgage lenders. So for example, like Veterans United Home Loans or Fairway Mortgage. And we say, hey, the number one reason you're losing loans is that your borrowers can't pay for closing costs. So then they partner with us. We onboard their loan officers, and they'd go in and say, hey, my borrower needs closing costs, refer them to us. So there's no marketing or customer acquisition cost on this side of things. Borrower applies, uploads their mortgage commitment, so we have no underwriting expenses, and we can fund loans for veterans within a couple hours. So I still do that one. We've helped about 900 veterans over the last 13, 14 months purchase their home. And all of this is kind of led into me working with Scale and it being a perfect fit for me with being on the side of getting the opportunity to work with, these 22 companies. I feel like I've been part of their team over the last 12, 18 months, but also being on the investing side too. And there's some other things sprinkled in there that I've done over the last 4 years, starting angel groups or whatever. And I guess most recently, with Scale. So Scale is our national brand. I also started Flyover Tech, which is more of an extension of Scale, brand for more undercapitalized markets. So the biggest issue you see with, say, Central New York or like Columbia, Missouri, Columbus, Ohio, is like they each have their own little like ecosystems, but they're not great at collaborating with other ecosystems. And without collaborating in other ecosystems, you can never have the resources, network effects, knowledge that you have flowing in Silicon Valley, New York City, and Boston. And so it's like, why aren't these people better connected, and how do we do it? And so started Flyover Tech just to get a bunch of people in a Slack and start connecting founders, investors, service providers, community builders. And so that's what another initiative we've had going on.
What do you do for staying awake, given the 83 things that you do on a continuous basis?
I drink a latte with 4 shots of espresso every morning.
There you go. Yeah, I'll tell you, I was in Italy for a period. Well, I was in the Air Force, so I was also in Italy, but during the last 4 years, spent time there, and it was so interesting. I think of the Old West, where people would walk in off the dirt road and they'd give me a shot, and they'd go whoosh, and they'd slam the shot, and there would all be these shot glasses that are either filled for drinking at that point or emptied for having been drunk. And it was interesting when you brought up the latte with the 4 shots of espresso, that you go into a restaurant in Italy in the morning and the same thing exists, but they're espresso. And these people go, and they inhale the aroma, and they want to feel it just kind of burn through their body, and they just, and it's like it's like the shots in the Old West. So I guess that could work.
Hey, I mean, if it's like midday and I'm like struggling, so there's a coffee shop literally like right, it's like 2 steps down there.
Yeah.
Let's go down there and get a Cubano shot. They put like a little sugar in it, but it's just a shot of espresso. And
Right.
Yeah.
But it's good to see that you have a plethora of diverse interests, but they all seed from you as a human, right? Because I can tell in what you say that, you know, all these things kind of spring out of you, but at the same time they have a centralized core of what you feel comfortable. I won't say the word controlling, but bringing your unique skill for. And so it's good to see that you're kind of giving and at the same time receiving. You're receiving so that you don't have to feel that, you know, you're being drained. Like you said, it's interesting that I get paid to do this when I enjoy it so much, right? And that's kind of the way I think a lot of businesses could be if they didn't have to worry about something that made them convert their mind to go after something that isn't what they're looking for, because they don't have funding to get what they really want. And what they want is actually something that would sell or bring value to consumers or customers,
Yeah.
which I think is the key, right?
Yeah, and I think there's somewhat of an education component too. Is like, if you're trying to raise money and you're struggling and it's holding up everything, you're like, whatever you're trying to do, launch a product or whatever, get new customers, scale the business. First off, it's like, why are you raising money? What are you raising money for? And I guarantee you that more times than not, you take a more thoughtful approach to that, and you're like, well, shoot, like, I don't actually need to raise $1 million. I could probably raise 200.
Right.
The business just as good, because I'm being more scrappy, more thoughtful about this process. Right. I don't actually just need to hold everything up by trying to close $1 million on a dime. And I think that's, you know, it's all this like marketing thing. You know, you start a company and you're like, I'm going to go raise a bunch of money, and like that's like, to you it's like success, and it's like, no, that's not. First off, that's short-term success. Most companies that raise $1 million still fail. And what is success is like actually building a product and actually delighting customers. And everybody forgets because they get so wrapped up in like the sexy side of raising money from venture capital, and then
I think it's a distraction. I think raising money is a distraction. It would be so good to be able to look at an investment conversion process, right? Where you have a credit line that allows you to, if successful, pay back the credit, or if still struggling and needing success, but the vision is obvious, then it becomes a equity position conversion, right? So if you go from 100,000 in credit, once you use that up, you say, well, I'm still going to need more. Then it creates an equity conversion of what you and the seed investor feel is a reasonable consumption of equity based on the investment of dollars having been consumed from what we would call a credit line. Therefore, you remain a scrappy son of a gun, and you're trying to work on things. And if you're successful, then you walk away holding more of the equity in your company. If you're not successful initially, then you're sharing that equity with someone that's sharing the risk, right? And that kind of leaves that it's not like you won because you raised $1 million. You should say, I won because that $1 million allowed me to do this, right? And I agree with you. It's really a weird thing that, I have a partner, not a partner, but a person that I helped kick off a company out in, I think he's now in Serbia, but he was in Sweden. And it's a material exchange, which is for the apparel industry and trying to unify globalized materials for the Ralph Laurens and so on in the world, so that they go look for materials and pull that data down. And this guy is on his third round of investment, and in each mountain, he hillside, and then little mountain, then bigger mountain, he considers success being raising the money. And I'm saying to him, it should be that you shouldn't need to raise the money because you're successful having been able to turn that money into value to the market. Oh. So I agree with you. It kind of changes the mindset of the visionary to become someone that becomes tactical rather than strategic.
To your point, Brian, that's one of the challenges I think in the VC world often is the success is determined upon the exit and the valuation at exit, which is often a significant multiple.
Right.
And so they get stuck in this sort of, the goal is to raise the next round because that's when the next valuation is, and where everybody marks up, all right, how much more is this worth now? And so the whole return model is sort of based on that. And that's why I think you end up with a lot of companies that have kind of almost questionable fundamentals, right, in some ways, but because they were able to raise the valuation, they're considered successful.
Right.
It's like us, why? Yeah, go ahead, Brett. Sorry.
I'll say, I started out doing business valuation work where you're taking different approaches, more theory and fundamentals of this is what public companies are trading at, this is what companies are being bought for as a multiple, or this is what your assets are worth. And so I grew up knowing that's how you look at companies, and then you get into venture, especially in 2020 to into 2021, and it's there was literally no fundamentals other than it's a hot potato of passing it to the next investor,
right,
that they invested a higher valuation, and then interest rates go up, inflation, market kind of comes back to realization that oh shoot, you actually have to have decent margins and be profitable, and you can't just have 20 engineers that work 5 hours a week on your payroll.
Right. Yeah, I mean, the whole thing is value to cut. I've been doing technology for, 40 years, since 1980. And the whole mindset should be that what value you're bringing to the market that you're serving, right? What appeal is there in what you're delivering, but also what value is there post the delivery. And to your point, and to James's point, people that are running companies of this type that had a vision, all of a sudden convert their vision to what's the value of my company as the market sees it. And it's almost like a performing art where somebody writes a song that is personal to them and they get on stage and you don't see the person singing it and the emoting of the emotion that they had when they wrote it. Instead, they're now singing to an audience, which they're looking for that recognition and appeal, and it transforms the song to something that's more plastic. The same thing in relationship to businesses. They lose focus on why they exist. And what I think is critical, and this is why I look at the Central New York as a possibility of gestating a whole new breed of entrepreneurs, is we really have to look at what is the transforming value. If you look at nanotech, or if you look at the whole thing of smart cities, or if you look at the whole thing of what I'd classify as, taking the world and bringing it into some kind of digitally connected profile, there's a lot of technologies that need to be developed or leveraged in a different way. And there should be a lot of entrepreneurs where ideation then forms into creation. And all of that should result in, market success. And it shouldn't be what's my, multiple at this point and how can I exit? It should never be where's the door. It should always be where's the next, step in evolution.
How do you build this into your thesis, Brett? Like, so I'm curious. I find a lot of VCs in regions like ours try to find this sort of almost like middle ground, where you're not looking at it like a cash flow business or something like mid-market, but you're also saying, yeah, but I'm also not going to invest in something which, like social media, where it's like, well, it's not even going to have cash flow until it has like 10 million users. You're trying to find this in between. Is that your perspective? What's your thesis on all this? I'm curious.
Not necessarily. Our thesis when we're looking at companies is, does this company and this founding team have the potential to build an outlier company or $1 billion company or whatever success is?
Yeah.
And how they do that is, it's going to be a case by case basis. And so we're not looking for cash flow dividend returns. We're looking for 3, 5, 10x fund returners every time we make an investment.
Well, let me ask a clarification. So, you're a generalist, but how broad of a generalist do you like to scope? Are you still interested in things that are like, more SaaS, or are you open to like I said, social media or things that are leveraging, much less cash flow driven business models?
We have done both. We've got a social media company in this cohort.
Cool.
Say that again.
We've done both, and we've got a social media company in this current cohort that we're running.
I got you.
Yeah.
Interesting. So
is that called Twitter? I don't know if that was.
No.
Oh, no.
I think it's be better than Twitter.
Yes, good.
It's called Name Drop. And so think of, so it's got many different applications. I can run through a couple of them. So what happens is, say I'm a student at University of Missouri and I want to better connect with students locally. So it's more localized social networking. So I can go on Name Drop, drop a pin, it pulls out a radius so I can see who's in the class. And I can start talking about a topic and say, hey, what's the answer to this test question? Or like, does anybody like this teacher? And then we can start talking about this topic. Or let's say that you're a business professional and you go to an event and it's really hard for you to connect with everybody there. So you drop a pin, you drop a name drop pin, pulls out the radius, you can take a screen grab, and then after the event, you can go back and follow up with everybody that's in that screen grab, who is in that radius of the event. So it's more localized social networking, and there's more things you can add, like features on top of it. So there could be even e-commerce. So you drop a pin and be like, who's selling a fridge on Craigslist in this area? And so it's really so they launched like an MVP feature of the app at University of Tennessee, and they had 4,000 downloads in 10 days.
Wow.
And the feedback was like, this is better than Be Real. Like, we love this app. And so they've taken a lot of feedback from that, and they're about to explode this across sororities at like 50 different universities.
So let me ask you a question. So you just popped in my head a little bit. There's something, and this has nothing to do with what I talked about before, but what you just talked about is something that is what I classify as an app layer, right? Like a meta app, because it seems to have the ability to technologically link into other content derivatives that say, I want this radius and this is my topic, go find me people, which means it's kind of trolling through or has a repository of content having already trolled through a radius, and then it goes, I'm going to bring you these people, and it knows how to make that connection. There's an idea I have that I would like to talk to you about, which may be something that is like, you know, how Salesforce.com is something that has layers of apps that kind of leverage that infrastructure. And so what you're saying tends to bring to mind something that I think there's a layer that can be put on top of that if what you're saying is really what I think that engine does. So even if you don't want to talk to me about Central New York and some ideas in regards to that, we should have a conversation on the other one, because that's been brewing for about a year in my head, and I don't know where it came from, and I'm not sure where to go with it. But it's a pretty strange.
Happy to talk about both.
Yeah.
Yeah, I think like there's a lot of opportunity in social media. I mean, these are not necessarily my opinions, it's me coming from me reading information, but the whole new trend on unraveling like these horizontal platforms into more
Right.
verticalized solutions, I think is interesting. You know, where it's like LinkedIn is only good for like a few different professional groups as
Right.
everybody. And you know, we've got a company in the health tech space that's trying to do a better job at connecting patients with physicians that are more around demographic and psychological characteristics, as opposed to, does this person meet my health insurance requirements?
Right.
So yeah, I think there's going to be a lot of opportunity in the future, because the value of a lot of these horizontal social networking platforms has been somewhat diluted over time.
Right. Yeah, it's kind of tough. You can't, it's like the elephant consumption, right? You can't take on the elephant, but there is a way to be able to look at all of the things that are there and determine how you create a meta world that links all of them together, letting them stay where they are, but bringing them in a unified way. And, you know, like the LinkedIn versus, you know, I remember AOL, that was way back. But the fact is, there's all these things that target a certain region, because that way an investor will talk to them. But having had all these been built and having what I'll classify as distance areas between LinkedIn and whatever else, right? The meta world is shooting too far, but there is a layer that exists that could be built that horizontalizes a lot of these vertical social media things and gives a different value to those that want to leverage the connectivity of all these. And yeah, you're a different kind of guy that I've heard. You know, James brings in people that are investing or investors or investment groups, and yet you seem to still be in the ideation of things that could be created at the same time, finding ways to be able to CPA analyze whether those things have, you know, potential future value, right? So it's kind of a weird mix, and I appreciate it nevertheless.
Thank you. A little over half of our companies were at the idea stage when we invested. So
You mentioned on that note earlier, I picked that up. You said the data suggests that historically generalist funds have outperformed vertically oriented funds or industry specific funds. Tell me more about that. That's the first I mean, I've never really researched it, so I have no basis for that. But it runs counter to everyone's general understanding on that. Tell me more about that. I'm curious.
Yeah. I can try to pull out the data source later, but yeah. So generalist funds have outperformed thematic funds or funds focused on a specific industry thesis. Part of the reason is, okay, so you start a thematic fund, you're trying to differentiate yourself for LPs. Okay, I have this unique insight. We have this network in this industry. Let's bring in all these people that are really good at like banking, and we'll start a fintech fund. It's like, okay, great. And then that's, you know, can help you market to founders and say, hey, we also have this added resource that you can take advantage of. So like that's backstory. A lot of that's not everything, but a lot of the pros of having a thematic fund. But then take like a generalist investor and they're like, I don't care. I'm just going to invest in good deals. And if I'm just a fintech investor and say my buddy sends me a deal in the prop tech space that could be $1 billion company, I'm not going to pass on that. So if you're a thematic fund, you're constrained and you can only invest in this specific industry, and you're missing on this entire pool of potential really successful companies. And so that is one of the reasons why generalist funds have been better. They also get better deal flow. You get companies from all over the place, and as opposed to being stuck on one specific industry that's can also experience more volatility with.
Sure.
Now venture's not really subject to market cycles, but if there's something happening in a particular industry, your entire portfolio is going to be at risk of that, as opposed to having a diverse pool, which is why you invest in venture.
But I think there's something about generalist funds that requires that the individuals that are making the decisions or the resources that are available to assess the potential market opportunity have to be able to think outside the box, because there is no box. And you have to be able to think, I mean, it's really a strange way to do business, because everybody is always verticalized in their view of what they're delivering to market. And if you're able to, it's almost like being a chameleon, right? Or the pretender, like you just kind of float into that space and you assess it as if you're one of them. But prior to that, you weren't. And you're able to see it through their eyes and look at it through their vision, and then be able to go back into your, should it be worth investing? And then you say yes. But that means there's unique humans in generalist funds that have to be there, or those generalist funds will dilute and do crazy things because they really can't assess success potential. They're just almost like playing craps, right?
Well, it depends on the fund. If you're a bigger fund, you're gonna have more resources, so you're probably just gonna hire Bain to go do all the market diligence for you.
Mhm.
A smaller fund, you probably have a network of experts in particular industries, and you'll say, hey, you know, XYZ PhD, can you look at this technology and make sure it's viable? And so it depends. I mean, you do have to be a unique person. I would say on our team, Willie is probably that unique person, that he knows in-depth detail about literally every industry, and I don't know how, but he does. He's also like the most intelligent person I've ever met, so that's part of it. But yeah, generally it's you're probably leveraging a network to assess deals, unless you are. I mean, another thing with generalist funds is you're probably going to go with the power law, and you invest in 100 companies and hope that one makes it.
Well, that's the craps approach, right?
Yeah.
I mean, it's a roulette wheel. I'll do 43 because I know at some point it's going to land on it. But, you know, it's yeah.
I mean, if you're investing in good teams that have the skills to build, that have the technical skills to build the company, they can articulate what they're doing. They're trying to build something in a massive industry. The market dynamics are strong. Like I mean, you know, at the pre-seed seed stage, like how much underwriting can you do? You know, more downstream, if it's like Series A, Series B, it becomes more of a financial analysis, not so much how good is this team and
Right.
what is the future of this market. They've kind of already established product market fit and what the market is. So it's like there's only so much underwriting you do. It's you're betting on the team at the early stage. So
Right.
Interesting. So
I feel bad. There's other people, and I just keep capitalizing on your time.
So what it's about. So you've got, is your accelerator, are you guys in person? Like, do you recruit the companies to join you there? Or is it virtual?
They don't have to. I mean, if they want to, sure.
Okay. So
I mean, it's better to be in person, but like, no, we don't want that to be a constraint for us.
Cool.
So what were you asking, James?
Well, I wanted to just learn more about their different, how they approach them. Like I ran an accelerator and stuff like that. And I was just curious more about your process, like what you're not, so you're not in person. Is there like a clashing with mentors? Like how closely were you trying to follow the old Techstars playbook versus try something different?
So
And then
what
we'll go to Sam. Sam has his hand up. He's very polite.
So our approach to the programming or boot camp, whatever you want to call it, is,
Yeah.
and it's somewhat evolved since we did the first one.
Yeah.
So we do one session a week for like 45 minutes to an hour. That's bringing in, say, for example, Wade Foster from Zapier, and he walks through his journey building the company, some of the pitfalls. So it's more like real world experiences, not watching a YouTube video on how to do sales. And then it's open up for more Q&A specific to the founders, particular questions. So we do this once a week. And outside that, we do bi-weekly meetings with our team just to keep up to date what's happening. Beyond that, we fully lean in on the bug us. Our calendars are open. Reach out to us 24/7. Let us know when you want help, when you want to talk. Let us know who you want connected to. Do you need hiring support? Do you need help building financial models? Do you need help with sale? Like what? Let us know what you want help with, and we're here to make it happen. Like that's more of the approach, as opposed to we brought in 50 mentors. We'll do a whole mentoring carousel, and like it's more leaned in on like one-on-one time with people that have built companies. And us like actually helping you like source investors, talent, domain experts, customers. Like that's, yeah.
Wow, cool. And you have a studio side too. So how are you? I mean, that's very different. How are you recruiting ideas and founders for that? What's that? How's that look like?
Studio side is, so we've got internal ideas. Like Willie and his brother have all these companies they want to start. One of the first ones we did was Paytient, which directly came out of problems that Equipment Share had. So Equipment Share is the largest purchaser of heavy equipment in the world. So they do billions of dollars of heavy equipment purchases, which includes doing a lot of financing. And there's a lot of like downstream unnecessary legal costs that comes with doing research on who has liens on what assets, and as well as filing liens on those assets. And all those downstream costs usually go to the company. So it's like all of this data sits in these like public silos that's hard to access. So the current workflow is Equipment Share finances an asset, commercial bank goes, okay, hey, let me see who has collateral on your assets. And what they'll do is they'll hire their legal counsel, say Baker McKenzie. Baker McKenzie then hires Wolters Kluwer to do a UCC search, and then they send this document to Baker McKenzie. Baker McKenzie searches it, and then all these costs go down.
Right around the corner there.
So
Sorry
you
about
can
that.
have it to where you have all of this data in one place that is essentially Google search for UCC data, and that's kind of how we've approached one of the ideas for Paytient, and some of it has evolved over time and whatnot, but it's more so, yeah, ideas are coming from us. We brought in somebody who's very technical, very capable of founding the company, and then we give them additional resources as opposed to just the accelerator.
Sam, you had a question. Sorry if I skipped over you there.
No, not at all. Thanks for the great talk, Brett. Just circling back to the investment piece. So I'm part of Leicester Startups. We're a startup community, the same sort of principles as Brad Fell's model. We run accelerators, startup weekends, all the usual good stuff. We've got some traction. We've got local startups raising money. And just recently, we started our investment club, very informal. But I was interested in what you had to say about how you got your investment model. I have to confess, I was multitasking at the time, so it's my fault, sorry. So we've got investors, but over here, we've got something called the Financial Conduct Authority. We don't really want to go down that route because it's messy. And I wonder, is that what you did with your, have you gone through the regulatory processes, and, is it an investment fund, or is it just a connector piece and you take maybe a percentage cut of any deal raised?
We're structured like a typical venture fund. So we
Right.
have the full LP, management co, GP structure.
Got it. Okay. And that's not a quick and cheap process, but I guess by virtue of having lots of investors involved and lots of funds coming in, it's just the most appropriate way to do it. Yeah. Okay. Thanks for sharing that. And if you couldn't do that, how would you? Is there an alternative way? I mean, yeah. If you said if that wasn't an option, is there another model that you could use to try and deploy capital into startups?
As an accelerator fund?
Yeah. I guess that would another. Yeah.
And the goal of that accelerator was to produce high returns, or?
Yeah. I mean, we're a community interest, so we're not for profit. Returns are important, obviously, but even just generating some income to keep the accelerator model running. So maybe it stays free. Ours is free at the moment. We don't take equity, but we want to try and go in that direction. But I mean, I have a daytime job. We're just doing this on the side.
So I mean, it's going to be completely different so our incentive is like, we want to help founders produce generational wealth. Similar, it's like that. Willie's whole thing is like altruistic capitalism. It's like, we want to help people produce generational wealth, and we want to create outsized alpha for our LPs. But if the incentive is more just an economic development play, where it's more grant funding, then yeah, you would want to structure that completely different, because your goal is not to produce returns, it's to help founders go to the next step.
Yeah, I mean, yes, you're right. I think there's a stepping stone to that longer term vision, which is where you're at now. Traditional accelerator or so. Yeah, we're trying to scale to that point, but it's just trying to find a way. Yeah, exploring the different models.
Sam, there are I've seen a lot of accelerators now where they find ways to kind of create a nonprofit and grant fund the program, and then they have a for-profit fund or something kind of financing mechanism that runs alongside it. So all of the cost burden and overhead and all that sort of stuff of the program gets carried in a nonprofit sense. It doesn't carry on top of the investors. That's a popular model these days.
Yeah, for sure. I have heard of something similar, but I mean, over here we get 20,000-25,000, maybe $30,000 equivalent to run stuff. So we're looking for that step change of how can we try and deliver? Maybe it's not free, just maybe we're an intermediary. We could somehow take some equity for the community interest company, so we've got some long-term sustainability, that might materialize in 5-10 years time. But we're also getting a bit of money to run it. I mean, I guess we want our cake and eat it.
Sam, I think we should run a hot seat for you on that.
Okay.
We haven't done one of those in a while. But if you guys if anybody else hasn't participated in that, that's usually like somebody poses a problem like this, and I'll post it out to the community, and those who are available and interested come in, and we just do this sort of like hot round thing to provide feedback and see if we can do something. I think the last one we did was probably over the summer. I'd love to do one of those if you're down for it, Sam.
100%, love to. Thank you.
Okay. Any last minute questions for Brett before we close out? Brett, I appreciate your time, man. This is awesome. Thank you.
Yeah, thanks for having me. This was fun.
I want to follow up with you about Flyover Tech too. That sounds really cool.
We need to, so I've got a speaker series on that. You guys are all welcome to join.
Awesome.
Definitely apply to the Flyover Tech. I'll send you the speaker series though. It's a very, it's a great group of people I curated. Here you go. So we'd love to have you there, and then we're going to do something on deal flow. I'm going to have founders apply to do a pitch. We'll probably do some kind of deal flow pitching through Flyover Tech. And I've actually had one of my companies raised a round through Flyover Tech. So, and what I've heard is there's a lot of founders have gotten meetings with investors through that.
Awesome. I'm happy to share this across our channels. This is really
Please do. I mean, it's for everybody. Like we have an application so that it automatically pushes to like a directory of people.
yeah.
And also so that we're not just letting in anybody that's going to be trying to just sell stuff. I try to keep it have somewhat of a filter on the community.
Oh, sweet.
Yeah.
All right, I'll poke you email online on how to coordinate that, but totally got my support. And I see you got Chuck coming up in a few weeks too. That's pretty cool. So
Okay.
thanks, man. Thanks everybody.
Thank you very much.
Appreciate it. Cheers.
All right, stay safe.
Take care, everyone. See ya.
Thanks a lot. Cheers. Bye.